market can give you in the way of numbers, but I don't think anyone can deny, just by looking at the headlines and looking at your own 401ks that have affectionately become 201ks, that the marketplace has been probably the most volatile it's ever been in history. In fact, the first 3 years of the decade of 2000 through 2002, the market saw a 3-year back-to-back decline, which it hadn't seen since 1939. A lot of reasons for that, not the subject of this discussion today, but just suffice it to say that if you had a choice to invest in the stock market and have a piece of paper or some shares in a mutual fund, or actually own some real hard asset like real estate, especially now we have this perfect storm with rates being as low as they are, prices being as low as they are. Of course, you'll see that in a moment that that's here changing. So the opportunity and the time to do something is right now with real estate. If you look at the last 6 years since the start of the great housing collapse we know as the Great Depression, or since the Great Depression, I should say, we don't have to look very far to see signs of recovery. Nationally, home prices are rising at more than 30% drop since mid-2006. And according to Standard & Poor's Case-Shiller Home Price Index, they reported third quarter prices were up 3.6% from a year ago. And of course, the rule of investing is you hope to buy low and sell high, right? So if the market is poised to increase, and we're seeing, in fact, we were talking about this offline before the webinar, you know, inventory levels across the country right now are rapidly diminishing. And the supply-demand equation is going to start to flip in favor of sellers and not buyers like it is right now. So go ahead and flip to the next slide, Charlie, if you don't mind. So we like to say that the future is bright for American real estate, and a recent National Association of Realtors article claims that existing home sales jumped more than 9% in 2012. The largest increase we've seen in 5 years. I know when this all started, you know, we never thought we'd see the end of it, but you know, smart money knows where to go, and hedge funds and large investors, institutional investors, even small investors have jumped in because they realized the opportunity that real estate represented. And so home inventories, in addition to that, have hit a 5-year low in December 2012. Next slide, please. Let's give you some numbers. I like to quote a mathematician named Pythagoras, and he once said that numbers will eventually lead a person down the path of reason. And if you're wondering where real estate is going, I don't think you have to go any further than looking at this right here, where it says 84% of agents in the industry believe that real estate values and the number of real estate transactions will increase in 2013. We're already seeing that. 77% believe that new construction starts will continue to increase. Of course, that's good for the entire economy. When you start, the housing industry starts making money, especially the building industry. A lot more people are put to work that can now afford to buy the homes they lost in the debacle. 74% believe that their local economy will improve in 2013 compared to 2012. And there is no market in the entire country that's expected to see a decline in home values or real estate transactions in 2013. Now, you contrast that to last year, when 1/3 of the market's expected to see house values decline. So as you can see where the trend is going, folks, it's pretty obvious. Next slide, please. Actually, that next slide is yours, Charlie, so I'll turn it over to you. Charlie, are you there?
I'm sorry, I had my mute button on, Ray. I apologize. Thanks, Ray. And I've been using this slide for almost a year now. This was the quote that Warren Buffett made on an interview on CNBC last year. And it's gotten a lot of mileage. Most of you might have even seen this by now. If you haven't seen the whole interview, contact me. I'll be glad to send you the link. But it was interesting because, you know, he spoke about, you know, single-family homes. Is it a good investment to get into single-family homes? And he said, yeah, he'd snatch up millions if he could, if it were practical, but he wasn't very handy. And that sort of kind of frames what we're talking about here today. You know, what's the best strategy for you? I think that most folks that understand the real estate market now knows that it's a great market to be in. There's opportunity there. It's still a down market. There's opportunity there for a strong ROI. And so the question then becomes, well, how do you do it? You know, what's the best strategy for you? And so right after Warren Buffett made this quote, we started to see, and Connor, since really we spoke to you last, actually, we started to see a real change in our market with regards to what was taking place. You know, who was in it? Ray mentioned a moment ago, and we were talking about offline, that in some markets, you know, you have to make dozens upon dozens of offers on homes at or above asking price to get just a few. And so what kind of happened? And so what we learned was that the industry had kind of evolved, it kind of come full circle. It wasn't just we got into this business in 2007, 2008, and then it was just a lot of small companies. Yeah, they were called specialized REO companies, but now you see more of an industry kind of a flavor to it. It is very much like an industry now. There is multiple specialized REO companies that are out there to help you identify that real estate, do what needs to be done to make it successful, to take that piece out that Warren Buffett said, which is, I really understand the value in this, but how do I buy it? How do I fix it up? How do I sell it? How do I collect the rent on it? How do I do those things? And so the industry has sort of matured. And the next thing we started to learn was that people that, like a Warren Buffett, he didn't just make a quote that real estate was a good idea. Just a few short months ago, Berkshire Hathaway purchased Prudential Real Estate. So now Warren Buffett in his investment portfolio has a portfolio of real estate, one of the largest real estate firms in the country, actually. John Paulson, who famously predicted the housing bubble was going to burst, has put almost $300 million of his own money in real estate. And then the thing that we really began to see, was hedge funds. And these real estate investment trust groups started to pop up. And we started to bump into them noticeably in about late November, early December, not really knowing their strategy or what their goals were, or what their needs were. But we started to witness them firsthand ourselves in about, like I said, late November, early December. So we made a conscious effort to engage with them. Who are these folks? Hedge funds are large groups of investors that pour millions of dollars into the real estate market. Blackstone is the largest in the country. They are buying all over the country, but they were really focused for a long time in California, in the low end of the California market, and by that I mean homes under $200,000. And if you know the California market, you know that if you're buying a home in California for $200,000 or less, it's the low end of the market. But we started to see these different groups, and there's about 40 of them, hedge funds around the country that are actively engaged in buying as much real estate as they can get, believing for a variety of reasons that the safest place for your money today is in the real estate market. As I said, private equity firms, real estate investment trusts. You can see I pull this stuff all off the internet. There's a lot of good information on the internet that you can see about why they're in this market. And of course, some of it's the obvious. I mean, you can only threaten to go over the fiscal cliff so many times before people start to say, eventually we're going to go over the fiscal cliff. And so when that occurs, where's the safest place for our money? I mean, I read something interesting about a month ago, and that's Russia, the nation, is investing all of their money in gold, believing that the euro could collapse or the dollar could be devalued, and the best place to have their money is in a commodity. Well, these hedge funds sort of believe the same thing in terms of what's going on in America. Where's the best place for money? Well, it's primarily real estate. So one of the questions that we asked was, well, is this a good or bad thing? I mean, we've got these big partners that are in this business now. Is it good? Is it bad? I will tell you that we have had some good experiences with most of these groups so far. They're looking to roll up inventory, which is good for any of our investors who may have bought 2-3 years ago that now want to get out. That's a good thing. But I pulled a really interesting article off the internet just a few months ago, and it says, why hug a hedge fund buyer today? And it gave actually 5 reasons as to why it was actually a good thing for our industry. I really boiled it down to 3. There's really 3 reasons, and here's what the 3 reasons are. First of all, they're driving up prices. That's first and foremost. As Ray alluded to in some of those slides, we're seeing a growth in the real estate market now for the first time in a little while. Inventory is still strong. We are still able to acquire good inventory. It is becoming a little more difficult, but we believe that 2013 is going to be a great year to be in this market. I think most people do. The second reason is that they're buying inventory that we would call undesirable. When we buy a property, or if I was to advise any of you that were to contact us and say, I want to do this myself, can you give us some counseling and advice? We're always glad to do that. But what I would always tell anybody is cherry pick. Don't just buy everything you can find. You got to cherry pick. Hedge funds aren't necessarily cherry picking. They typically look for a 7 to 9% yield. So their rate of return is lower than what we would look for our clients. And a large part of that is the fact that they will buy inventory that's been on the market for a while, been empty for a while, and it may take them a while to put it into rent-ready condition again. So that part of their portfolio drags down the overall values in terms of rates of return. Why is that good for people like us? Well, it's increasing the values of entire neighborhoods. If there's 5 homes in a neighborhood that's been vacant for 5 or 6 years or 4 years or whatever, by them buying those homes, rehabbing them, installing a renter in them, it just raises the value of the entire neighborhood. And then finally, the thing that we've already experienced for our own people in our own group is that they do provide an aftermarket for sellers looking to get out. So no longer do you have to go looking. If you've got a home, let's say you bought 5 homes 2 years ago and you've experienced that return, you've taken some tax benefits from that experience, now you want to get out. Well, finding buyers right now isn't real difficult. These hedge funds provide a sort of a built-in aftermarket for those looking to exit. So who are we? REO Reseller, like I said, we've been around since 2000, late 2007, early 2008, right when the meltdown sort of occurred. We would be considered a specialized REO company in that what we focus in on is how do we help that smaller investor participate, but the folks that don't have that skill set to do the things that it takes, we provide an option of management options that you can choose from to help you manage that property, whether it be short or long term. And Ray will give us an example here in a few slides of what a sort of an example of a buy and flip and what a buy and hold sort of looks like in today's marketplace. This next slide is our formula, and we always get people on these calls that want to do this themselves, and that's great. If you've got a skill set that lends itself to participating in this market without the need of a specialized REO company, I would just say take a look at what we've learned. It might be applicable to what you're going to do. The first thing you want to do is obviously is to research the area. Where you buy at is very important. You want to make sure you want to cherry pick. I already mentioned that earlier. We buy about 10% of what we see, and actually that number is probably down a little bit now because in many cases the inventory that we do see that we do make offers on, in some cases we can't get because somebody else has already bought it or somebody else has overbid for it. It's kind of interesting. I was interviewed about a month ago on the Wall Street Journal radio network, a show called Real Estate 360, and I was mentioning to the host that real estate, these hedge funds managers are overbuying. And she came back and she made a very good comment. She said, yeah, they're overbuying, but they recognize they're buying still in a down market. So from their view, they're really not overbuying. They're paying more than asking price, but from their financial analysis, they're not really overbuying at all. They're still buying below market value. You still want to cherry pick is the point. Strong rental markets are essential, and markets where there's always a strong resale value, where there's a market to resell the property. Those are the 2 key components you want to look for. We buy REOs. We do some foreclosures, some private party sales. If you don't know what an REO is real estate owned by a bank or a financial institution. We do not buy the bulk lists and tapes. I mentioned a moment ago that hedge funds will buy those bulk lists and tapes. We do not do that, and we don't do it simply because we buy a property first before we resell it to an investor. So if we can't resell it, we own it. So if we don't want to get stuck with a portfolio of 30, 40, 50 properties that we can't rent or have high costs to rehab or in a bad part of the neighborhood where it won't have a strong resale value, so we do not buy the bulk lists and tapes. We buy based on the yield, not on the comp. The comp market right now is slippery anyway because of what went on in 2004 to 2008, which caused the bubble to burst. Part of that was comps being brought in at numbers that weren't consistent with what reality was. And so we don't look at a comp, we look at the yield. We look at it from the perspective of investment. What's that property going to, what can we buy it for, what can we sell it for, what can we rent it for, what yield does that give a client, and then ultimately what can they sell it for. That's what we look at. We then provide a fully turnkey managed system to help you manage that property short or long term. And everybody's strategy is different and should be, depending upon your own personal situation. Is it a 1 year buy and flip in part of your model? Is it a 3 to 5 year? Ray's going to give us an example of sort of a hybrid 3 to 5 year buy and flip. That used to be considered a buy and hold. That's more of a buy and flip now. But Ray will go over that with us in a few slides here. I always like this slide. CNBC, it kind of framed 3 critical things. Home prices haven't bottomed out yet, especially at the low end of the market. And here's what's interesting. We were always focused at the low end of the market, houses that we resold from $39,000 to $59,000. What we really find sort of reassuring is that now that the hedge funds and the real estate investment trust groups are in this space, interestingly, the majority of those folks are focused on that same low end of the market, not trying to buy homes in Laguna Beach or in Orange County or in the San Fernando Valley. They're not looking at those properties. They're looking at properties where they can buy them and sell them in the $50,000, $60,000, $70,000, $80,000 price range. That low end of the market creates a better yield, and I'll give you an example here in just 1 second. And then it goes into talk about, how does an individual investor get in? And the answer was retirement funds, and Karin will speak to that when it's in a few slides here. But we do probably 70 to 75% of our business is really done through folks who, as Ray said, had a 401k that lost some value over the last 5, 6 years, that want to rebuild that. They want to rebuild it, get monthly cash flow, and then ultimately sell and at a profit and rebuild that retirement account back up again. Our chosen market at the moment is Birmingham. Now we do have opportunities in other parts of the country. Jacksonville, Florida is a market that we're currently in, but we've had really good success in Birmingham. And it was interesting. I saw an article in the LA Times about 2 weeks ago about what's going on in California real estate, because people always ask, why are you not in California? You're in California. Well, we're not in California because you get a better rate of return in other markets. CNN Money called Birmingham the 10th best overall real estate market in the country, the 3rd fastest growing real estate market in the nation. Our investors in Birmingham from 2011 to 2012 saw a 17% increase in sales prices from 2011 to 2012, and we do believe that 2013 will be even stronger than that. The other thing we like about Birmingham is we're very few hedge funds there. I did speak to one the other day on the phone, so there is one group there, and it's interesting what they're doing is they're looking to piggyback off groups like us who have infrastructure and a presence on the ground that can provide for them the infrastructure they need to first identify the property, rehab the property, and then ultimately rent the property out. But we do like the Birmingham market quite a bit. There's a lot of new construction going on there, especially in the downtown district, new baseball stadium going in. But we've had really, really good success in this particular market, and we intend to stay there for at least the next little while. I've used this slide now for a couple of years. Why do we buy in the markets that we've chosen, Jacksonville, Florida, Birmingham, Alabama? Why are we there? Well, the answer is real simple, and again, this is the same exact formula that these hedge fund managers use. It's real simple. It's just math. I live in Orange County. If anybody that knows the market here knows that 5 years ago, the median price home was $650,000. Now it's down under $500,000. Now that doesn't mean you can't buy a property in Orange County for $500,000 that was once worth $8. That'll probably appreciate back up to $800,000 one day. That's probably true. But the rental market for that property is going to be $2,200 to $2,500 a month. Now you can take that same $500,000 and you can invest that in other parts of the country, and you can see a yield or rate of return 3 times that, because typically a $50,000 home will rent for right around that $700 per month range. So your return is just that much greater, and that is the exact reason why these other larger institutional investors are focused into these markets as well. It's just a simple diversity in your portfolio, more properties. If that one renter moves out of that $500,000 house in Orange County, you've got 0 income. But if you've got 10 properties and you lose a couple of renters, you're still getting a higher rate of return. So it's a lot safer investment. That's why we're there, and it's just reassuring to know that some of the really acknowledged, smart investors are doing the same exact thing. Ray, if you're up to it, you want to go through a quick example of a buy and flip?
I'm always up to it, my friend.
All right.
All right, so we're going to show you here now a buy and flip. Our price is $44.9. That price is all-inclusive. In other words, there are no additional title, escrow, rehab, anything. It's one price, $44.9, and it. So you simply buy one of our foreclosures, we rehab and rent it, and during that process we are sending you checks to ensure that you have instant cash flow, and then of course once it's rented you receive the net rent. And then in 3 years or so, depending upon market conditions, there's no hard or fast rule that says it has to be 3 years or 4 years or 5 years. If the market looks good and we can sell for a profit in a year or 2 years, well, we'll do it if you want us to. And so that's the basic model. Year 1, 10% rebate is guaranteed to you. That's $374 per month. We warranty for 1 year all repairs and vacancies. Essentially, that's what we're doing. So the $44.90 is a rebate to make sure that you have instant and immediate cash flow in the absence of rents, because it's going to take us a little while to get the properties rehabbed, and it doesn't take long at all to get them rented. But rehabbing, especially with as many as we're rehabbing on a regular basis, that takes a little time. So with the rebate, we guarantee you an income stream, and we guarantee the repairs that we do on the rehab for a whole year. In year 2, you're looking at net rent. In other words, taxes, insurance, and management will be taken out. And on our buy and flip model, it's more or less a partnership with us where we split the profits 50-50. You get to keep all the rent. We're just talking about the property appreciation. So essentially, you have the opportunity to earn a 10% minimum rate of return on cash invested, and then split the profits on appreciation with us 50-50. And of course, when you can take 10% rate of return plus the potential for appreciation on the back end, your returns improve that much more. 44.9, there's the synopsis of what it would look like over a 3-year period, the total income stream on a year-to-year basis, and of course we're assuming that we didn't have any rent in year 1, which is not likely to be the case. So that number should actually, we're just being conservative here. So if you add it all up, you have sold it for 54.9. I think that's very, very reasonable and probably a little conservative. And your projected profit total is $18,900. Your total rate of return is 14% on an annual basis. Again, tied to real estate, a hard asset, not a paper asset. Next slide, John. And there is simply a scenario of one home that was sold recently, and you can see that that is a decent-looking house for $44,900. I almost can't believe that you could buy prices at in this range. In fact, if you calculate the price and then the square footage, you couldn't build a house this inexpensively. And the return on this one, just as an example, was 12.86% based on projected rents. Next one.
Yeah, and that is a buy and hold model there, that last slide, Ray. And yeah, we did sell that particular property. But thanks for that, Ray, and thanks for being here. Karen's going to come on in 1 second. I want to thank everyone for being on here today. We really appreciate your presence. I'm going to leave both my and Ray's phone number up here on the screen for just a second as we hand the control panel to Karen. Karen, thanks again so much for being with us today.
Yeah, Charlie, I greatly appreciate it. It's nice to know that you can still buy rental property. I hear a lot of rumors about what the market's doing, so it's nice to get an update. All right, so once you change the presenter over to me, then I'll show you my information, and we'll go forward and talk about how we can invest using self-directed IRAs. My name, again, is Karen Hall, and I am president of UDirect IRA Services. What we do is we help you self-direct your retirement account. What we don't do is provide tax advice or legal advice or tell you, like what would be a good investment. We're not giving you investment advice either. What we're doing is helping you self-direct your IRA, which is very useful. It keeps us busy all day, that's for sure. When it comes to IRAs, of course, they are all about retirement savings. And when it comes to saving for retirement, there's something like a $6.6 trillion deficit between what Americans have and what's needed for retirement. Some simple math here. If you had $100,000 in a retirement account and you're 59 and a half and you knew you're going to live till you're 86 and a half, so you took regular monthly payments, assuming no gain or loss, you would only have about $400 a month to live on. So we all need to save more for retirement, and self-directed IRAs can help you do that. Now, when it comes to the total amount of money in IRA funds, I just got an update that there is something like $5.3 trillion in IRA money, but altogether, I need to update this figure too, that the entire pool of retirement funds is about $19 trillion. Only around 3% is invested in alternative assets. So there's a lot of money out there in retirement funds. If you have not heard about self-directing an IRA before, and this is the first time, you're in good company. It surprises me. I've been doing this a long time, and I'm always surprised when I meet somebody who's never heard of self-directing their IRA, because you've been able to do this for almost 40 years. This is nothing new. Ever since Gerald Ford signed the ERISA laws into effect, you've been able to invest your IRA in anything except life insurance and collectibles. So the only difference between a typical IRA and a self-directed IRA is the assets that plan can buy. So we all know our typical IRAs are invested in the stock market pretty much, but a self-directed IRA can take it quite a step further and do things like invest in rental property like we've been talking about today. Maybe take your IRA and make a loan to someone. You can invest in property that's it's in foreign countries if you want. You can invest in metals and all kinds of things, Now, like any other IRA, with a self-directed IRA, if the account suffers a loss, you're not taking a write-off for that loss, and those funds are not easily replaced, so you just want to always make sure you do your due diligence before you invest. It's extremely important. So the limits, as I was mentioning before, if you go to irs.gov, that website, and go to publication 590, so it's irs.gov, pub 590, it talks about IRAs, and it says that an IRA can invest in anything except life insurance and collectibles. And I throw S corporations in there as well because you know, they're also included. But your IRA can invest in pretty much anything else. Now, if you are currently employed and your employer offers you a retirement plan, I mean, that's great, because especially if they're matching, because that could be like free money to you, and it's a wonderful thing. But you may not be able to use those funds to self-direct. In fact, you probably have to wait until you leave the company to roll over that retirement plan. But what you can do is go to your plan administrator and request what's called an in-service transfer. And there may be a chance that you may be able to get this and roll over some of your IRA funds or your 401k funds into an IRA. But again, if you're employed, you have a 401k, 403b, 457, you pretty much have to leave the company before you can use that money. So let's talk about self-directed IRA rules. I think this is important because if you're going to self-direct your IRA, it's just really crucial that you understand what the IRS rules are up front so that you're not disappointed. Number one, you're not going to borrow money from the account. You're not going to use your IRA or to sell, you know, to buy property you already own. You're not going to sell property to it or any kind of asset that you already own to your IRA. You don't use it as security for a loan, and you don't use it to buy property for personal use, present or future. Now, to take it a step further, certain people are qualified and certain people are disqualified to the IRA, and this is really important. Disqualified people are your lineal ascendants and descendants, your parents, your grandparents, and their spouses, you and your spouse, then your children and your grandchildren and their spouses, all disallowed to your IRA or disqualified. Now, the people who are allowed are the people who are out here to the sides, like your aunts and uncles, your cousins, your brothers and sisters, nieces and nephews. And so here's how that applies. With prohibited transactions, they all pretty much fall into one of these three buckets. And one is that neither you nor a disqualified person may benefit from the IRA. So what this means is no present benefit, personal benefit, indirect benefit. And my favorite example on this is the gentleman who came in wanting to use his IRA to make a note. Well, you can do that. Your IRA can lend money. That's acceptable. I said, well, who is your IRA going to lend money to? He says, oh, my sister-in-law. I said, well, okay, sister-in-law is one of the people out to the sides. You know, the sister-in-law is just fine. You can do that. And I said, well, when your sister-in-law gets the money, what's she going to do with it? He says, oh, well, he was so excited about it. He said, oh, well, she's going to invest in my company. So right there I had to stop it because the money starts in his IRA. It cannot end up in his company. That invokes what the IRS calls the indirect rule. If it starts in your IRA and ends up with you or your company, that is a prohibited transaction. So just keep that in mind. You can't benefit today from your IRA money. Number two, you're not going to buy, sell, or exchange property between the IRA and someone who's disqualified. Now notice this doesn't say transfer because you can transfer upon death, but while you're alive, you're not going to buy, sell, or exchange assets between your IRA and a disqualified person. So say, for example, your IRA is not going to buy a house your dad owns. Your IRA is not going to sell a house to your child, that sort of thing. And number three, a disallowed person can't provide goods, services, or facilities to the plan. This really catches a lot of people, and it applies in a lot of circumstances. But for example, say your mother wants to take her IRA and buy a rental house, and you're a realtor and you want to sell it to her. Well, you can't provide even the services for free to help her do that. So just understand you've got to stay arm's length when it comes to self-directed IRAs. Really, really important. Now, why is it important and what's a prohibited transaction? What do they do? Typically, it looks like this. You get audited. They find out you've committed a prohibited transaction. And if you truly have, what they do is, now there's no statute of limitations because an IRA doesn't file a tax return, so they'll go back to the date of the infraction and disperse your IRA to you as income, and then assess penalties and excise taxes and all that, and then you have to pay all that tax and penalty, and it's kind of a mess. So we do our best to try to prevent people from committing prohibited transactions. If you know about this up front, you're going to have a much better experience self-directing your IRA, because if you go into a deal thinking that you can do something a certain way and you can't, you're going to be upset. So just understand that the IRS has rules about what you can and cannot do. Another thing to have a good expectation about is how it all works. For example, you may not realize that when your IRA, for example, is buying a house, that you're not signing that purchase contract. It's being signed on behalf of your IRA, so you don't even sign it. So there's you on the one hand and your IRA on the other hand. This is not an asset you're buying personally. This is an asset that your IRA is acquiring. Also in the mix, of course, you direct IRA services. We are the TPA, the third-party administrator. We're your go-to source from beginning to end on your account. And when I formed the company in 2009, I needed to select a custodian to handle our clients' funds. And so I talked to some banks at that time, and back in 2009, banks were dropping like flies. I didn't think that was a very good idea. So I found a trust company that's non-depository, meaning that there's no checking and savings, they're not making loans to people, that sort of thing. So it just seemed like a much more stable situation. And so we use the services of a custodian, and that's how that all looks. Those are the players in the game, and again, a good expectation to have going in. So when it comes to buying real estate with an IRA, how do you do it? And also there are pros and cons, so we should talk about them. The pros, I think, number one, the pros is that there's just so much darn money in retirement accounts that there's a lot of money for your deals. That's a really good thing. But the pros can be things like all the gain, the money that comes back into your IRA like rents, or if you sold the property, the proceeds from a sale. All that money is tax-free in a Roth, tax-deferred in another kind of account. No time limit for holding the property. You can buy it today and sell it, 20 years from now, or sell it tomorrow, whatever you want. An IRA can actually borrow money, but this is really the number one misconception people have about IRAs. It's not a conventional conforming loan. Your IRA is not a down payment on a regular loan, and so I'll discuss this further in just a moment. Also, there's a potential to earn a larger rate of return on invested capital because, say, for example, your IRA bought a house at, say, $49,000, and later on, 10 years down the road, sold it for $149,000. So in this case, the entire amount comes back into the IRA, and it's untaxed. So the entire amount can go back out to work in the next deal. So you can compound your earnings faster because it's not being diminished by tax. And that can be very powerful as you try to build up your retirement account. Now, the downsides about investing in real estate with an IRA is that you're not going to take those tax deductions that you get when you own real estate outside the IRA. You're not writing things off. You're already getting the tax advantage because your IRA owns it. But think about this. If you have retirement money already, take a look and say, well, what is it doing? Are you happy with the returns you're getting? If you're not, and we say invest in what you know best, and if it's real estate, perhaps you could get a better rate of return. So that's the reason to use a self-directed IRA to buy real estate, because you can put your IRA money to greater use. There's no deduction for capital losses, of course, and you are solely responsible for all gains and losses. With self-directed IRAs, we're not ever telling you what to invest in. You're making all those decisions, and so you're solely responsible for whether or not that investment pays off. And of course, losses are not easily replaced. There are contribution limits. And so you really want to be very, very careful before you invest your IRA money that you've done your due diligence. Again, I have to really stress that. Now, I mentioned your IRA can take a loan. It's not a regular loan. I used to be a lender for a lot of years, and I was surprised about this because this is not a loan made to you, the individual. This is a loan actually made to the IRA. So it's non-recourse, which means on default, the lender is not going to come after you, and they're not going to come after other assets that your IRA owns. They're only going to come against the subject property, all right? So that's where it's non-recourse. Not a lot of lenders to choose from. But if you'd like, I can send you a list. If you will email me, my email is khall, K-H-A-L-L, at the letter U, udirectira.com, and I'll send you a list of non-recourse lenders if you'd like to look at that. So that said, a larger down payment is typically required. Like all lending, the rates and the terms are based on risk, so you want to discuss this with a non-recourse lender. UDirect IRA Services does not provide non-recourse loans, but we do have a list, not a list of approved lenders, I wouldn't call it that, but just a list we've compiled of people who say, yeah, we do non-recourse lending. So you can call them and check them out yourself and see if any of those lenders are, offer you something that you'd be interested in. Now, what's important to know, of course, you can't personally guarantee a loan to your IRA because you're disallowed to your IRA. But there's something to be very, very aware of before your IRA borrows money, and it is tax. The IRA can actually be taxed. Kind of surprising when you first hear about it, but there are two ways an IRA can be taxed. Number one is UDFI, Unrelated Debt Financed Income Tax. So basically, if you've got an owner-occupied property and there's leverage on it, the percentage of leverage can be taxed. So maybe you're 50% leveraged, you get a $1,000 rent check, 500 of that will be subject to this tax. That's kind of how it works, and you really need to discuss it with your tax advisor. The other time that an IRA can be taxed is called UBIT, Unrelated Business Income Tax. This is when you're running a business in your IRA. The IRS could say that you're running a business in your IRA if you're fixing and flipping, by the way, so keep that in mind. To read more about these taxes, again, go to the IRS website. It's irs.gov. Look up Pub 598. These taxes are reported on Form 990T, but you definitely want to get tax advice so that you fully understand the taxes and whether or not they apply to you. So buying real estate with an IRA, how do you do this? I mean, we all know how to get stock in our IRAs, right? You just pick up the phone and call, or you go online and you know, type a few things, click a few little buttons there, and the next thing you know, your IRA is invested in the stock market. Well, when it comes to investing in real estate, the process is pretty much the same. You've got an account, you're going to put an asset in the account, but here's how it works. Don't call us and say, oh, guess what, I just made an offer on a house, because that would be wrong if you don't have a self-directed IRA yet, because you're not signing the offer to purchase, so it's not you making the offer, it's your IRA. So open that account first. Here's how it looks. You open an account, usually we get it open the same day. Then you're going to fund that account by usually moving money over from another retirement account. That takes a couple weeks. So you could be a couple weeks out from having earnest money to put into this deal. And then once the money's there and you can invest, our turnaround time is 24, 48 hours. So open the account, get the money in it, and then shop for a property. Remember, you're not signing the offer. It's the IRA that's the buyer, so we'll sign it on behalf of the IRA. Now, going on to the next level here, you want to submit a direction letter. We call it a DOI, or Direction of Investment Form. And so you want to fill that out and give that to us along with the supporting documentation, which would be the offer to purchase. Then funds are going to be wired from your IRA. Typically in a real estate transaction, you're going to wire the money. So it gets wired, and you fund, you record, you get your keys, the tenants move in, and they make their checks payable, not to you, but to the IRA. It looks like this: custodian for the benefit of the IRA. And that's real important. Now I'm going to skip this example for the sake of time. But when it comes to self-directed IRAs, and when it comes to buying houses in an IRA, there can be a lot of expenses with houses. So what if the IRA depletes its reserves? One of the things you can do, say for example you need a new roof on the house, and your IRA doesn't have quite enough to do that roof, you can go ahead and write a check and make your annual contribution. Now the contribution is going to depend upon your age, your income, your account type. You know, all those things are going to affect this. So talk to your tax advisor about how much you can contribute. You could liquidate other assets in your self-directed IRA, like maybe your self-directed IRA has gold. Maybe you could sell some of that and use the cash to put the roof on the house. You could transfer money from another retirement account. Maybe you've got some stocks, bonds, and mutual funds over in a different retirement account. Liquidate those, transfer the money to your self-directed IRA, and use that to pay for the new roof on the house your account owns. You could bring on a partner as long as they're not disqualified. The IRA could take a loan. And in the worst case, you could just sell the asset. Now there's another way to do this called an IRA-owned LLC, commonly known as the checkbook IRA. Terrible name, really, because it's not a special kind of IRA at all. It's a special purpose LLC. Now this all came about because of a decision called Swanson v. Commissioner back in 1996. And so I'm going to condense a complex topic into a few minutes, but don't do this without getting a lot of professional help and advice. But basically, the self-directed IRA is going to buy 100% of the shares of a brand new, newly formed special purpose LLC. Now, you don't go to prepaid legal. You don't go to, LegalZoom.com for these. It's a special kind of document. It has to have special language. So the IRA buys the initial shares. The money goes from the IRA into the LLC's checking account. It's your IRA. You're the managing member of the LLC. You have checkbook control. and that is a huge oversimplification of the process and the responsibilities. But just know that it exists, and it's something you may want to look into. They say with great power comes great responsibility, right? At least that's what they say on the Spider-Man movie. So I get all my philosophy from Spider-Man, I think. But right here, you know that if you're going to have a checkbook IRA and you're going to be making these investment decisions, it will be very easy to commit a prohibited transaction because you're going to be making those decisions. So you do have a lot of responsibility. But if you'd like more information, we can talk about it. So what can you self-direct? Really, there are three kinds of plans. There's the individual retirement arrangement here, and I should throw into that list the inherited IRA because you can self-direct that too. The qualified plans, which is an employer plan, we don't do at UDirect. We don't do the plans that involve employees. But here you see the individual K. It's sort of a hybrid between the two. It's a 401k for just one person. So we provide those as well. Then there are these other plans that aren't retirement plans at all, like the Coverdell or ESA for Education Savings Account. You can self-direct that kind of account, and you can self-direct an HSA, a health savings account. So it's not just enough to say the self-directed IRA like it's just one thing. All of these kinds of accounts can be self-directed. So how do you do it? It's a three-step process. Number one, you're going to open an account. Number two, you're going to fund that account. And once it's open and funded, you can invest. So to open the account, we have a $50 setup fee. Our annual fee is $275, and that's a flat fee, regardless of the number of assets and regardless of their value. And then there could be some other smaller ancillary fees, depending on what you want to do, but that's basically it. To fund your account, you can write a check and make a contribution. Again, you want to ask your tax advisor about how much you can put in. You can do an IRA to IRA transfer. And if you do that, you use our form. You fill it out and you sign it. You give it to us. We sign it. We send it to your current IRA holder, and they move the money over. Or you can do a rollover. A rollover is when you take your previous employer's plan, you fill out their documentation, not ours, and then that's how you initiate the rollover, and then they send the money here into your self-directed IRA. So once the account is open and there's money in it, you give us a direction letter. You give us the supporting documentation. We'll do a review to make sure that the asset is administratively feasible, and assuming it is, then 24, 48 hours later, we disperse the money into the asset, and now you've self-directed your IRA. That's how it works. So we've gone through a lot of information fairly quickly. If you would like more information or some color, I'd be happy to go into it. Yes.
Karen, thank you so much for that.
Yeah, my pleasure. My pleasure. There's my email address, too. I'll just say it again. It's khall@udirectira.com. And our website, udirectira.com, has a lot of information to answer a lot of questions. And, Charlie, thank you so much, again, for letting me be a guest today. I really appreciate it.
Yes, and we have some questions, too. And let me answer the easy ones first. I have a question. Do we have properties in Phoenix? The answer is no. We are not in that market. If you're just set on that particular market, if you contact me, I could certainly refer you to somebody that might be able to help you there. The second question is, can you have the slides to this presentation? I could certainly send you out my PowerPoint. I'm sure Karen would probably be pleased to send out hers as well. However,
Sure.
We did record the webinar. So what we will do is we will send a recording of the webinar out to everybody. So you'll have a kind of a YouTube video of today's presentation. Now, Karen, for the hard question, let me ask you this. How does the IRS discover a prohibited transaction?
Typically, it's through an audit. You get audited, the IRS starts digging in your books, they start asking questions, and then, for example, one time we had somebody who deducted their expenses from their IRA-owned property from their taxes, and so they got audited, and the IRS is like, well, what are these deductions? And the person said, oh, don't worry about it. That's for the house my IRA owns. Well, then why are you claiming it on your tax return? You shouldn't be doing that. And so they dug further and found prohibited transactions. So usually that's where it starts, is through an audit.
Okay. Next question for you, Karen. Would you suggest a self-directed IRA for property even if it has not yet been obtained?
Absolutely, because what you want to do is open your IRA first and then obtain the property. It's a prohibited transaction for your IRA to buy an asset, like a house that you already own. So you really have to open the self-directed IRA first and then have the IRA obtain the property.
Got it. Okay, that's all the questions we have in the queue for the moment. I'll stay on here for a few seconds. Is there any other questions there, Matt? No, I think that's it. I want to thank everyone for being here. Ray, thanks so much for being here today.
Pleasure, Charlie. Thank you.
And again, I'll be sending out the YouTube video. Karin, I'll send you a copy as well as all the list of all the registrants as well.
Very good. Thank you.
Okay. Thank you, everybody, for being on here today. We appreciate it. We have another one today at 3 o'clock, and we have one more on Thursday morning as well at noon. So, again, thanks, everyone, for being on today. We appreciate it, and we'll hope to talk to you all soon.